Hi, everyone. We'll get started shortly. We're just waiting for everyone to arrive, and we are admitting everyone in Zoom. Thank you all for joining us today. Hi, Grace. How are you?
I'm good, thank you. It's good to be here. Thanks for doing this as always.
Yeah, how many years of have you attended?
I haven't counted.
Well, this is I think our close to 25th year, so um, we're excited.
Thank you.
Corey, do you have more on the wait list here?
Yeah, I'm just letting them in as they arrive. Right now, there's nobody.
Okay. Get started in about a minute. Just let's just give another minute and we'll get started. It's nice to see everyone's faces and names that have been attending the seminar and we work with. So this is great. Thank you. All right, let's just go ahead and get started. Good afternoon. This is the first time that we have hosted this at noon. We have been hosting this for close to 25 years now, as a breakfast in person. And since the pandemic, we had pivoted to the virtual, and we're keeping it virtual because a lot of our advisors can attend from the convenience of their office, home. So this is great. I'm Pragya Murphy, Senior Philanthropic and Impact Investment Advisor here at the Community Foundation. One of my key role involves maintaining and broadening the professional advisor network, as advisors are key to connecting their clients to us. On behalf of the Community Foundation, I would like to welcome you all to our CE Annual Professional Advisor Continuing Education Seminar. And as you are aware, we host this seminar in conjunction with the State Planning Council of Central New York, and this is in lieu of their October meeting. This year, the seminar topic is the new normal for charitable tax planning. Before we start the program, just need to go over the CE instructions for those who are seeking 2 hours of CE credits. For insurance, CE, CFP, and CPE credits, you must complete and submit the CE and evaluation forms to me in order to receive credit. Corey, if you don't mind putting that link to the CE form in the chat right now, that would be great. This was also included in your email when you registered, and you should have received it this morning. If you do need more than one type of credit, like insurance, CFP, and CPE, you only need to complete that main form online that's Corey just put up there. And just check off the types of CE you need. And also want to point out that please note that you'll need to fill out a separate CE form for CLE credits that is provided by Mackenzie Hughes. Thank you, Justin, for moving the slides. Appreciate it. So if you're seeking CPE and CLE credits, you need to submit 2 different forms we have provided, the main CE form and the CLE form provided by Mackenzie Hughes. And Corey, I think you put that on there, or if you could, that'd be great. One last thing about the CE, the mandatory verification codes must be included in all CE forms to verify your presence for the entire 2 hours of the seminar. We'll run the Zoom attendance report to verify your presence for the 2 hours. There will be 8 attendance codes posted via Zoom poll throughout the seminar. Please pay attention and jot them down in the CE forms as it'll pop up briefly. For CFP, there's no code needed. We'll just use the Zoom attendance. Life and health insurance CE is provided by POHS Institute. You need to submit the form with 4 mandatory codes. For the CPE credits, you must include at least 6 attendance codes on the form out of the 8 codes that we provide via Zoom poll. And lastly, for the CLE credits, you need to include 4 attendance codes on the Mackenzie Hughes CE form, separate from the main one. To be safe, I would recommend just include all of the codes provided. So with that, I just want to go over and thank the sponsors. Justin, if you could go to the next slide, that would be great. I want to thank the sponsors for their generous support for so many years, as this would not have been possible without their generous support. Our gold sponsors are listed here. They're Bonadillo Group, Crucial Partners, State Planning Council of Central New York, Mackenzie Hughes, and NBT Financial Group. Next are our CE level sponsors, Dermody Burke and Brown CPAs, a Financial Planning Association of Central New York, Hancock Estabrook, and POHS Institute. And now I would like to ask Melanie, our President and CEO, to say a few words and introduce our speaker.
Good morning, all, or good afternoon. I hope all of you can hear me. Let me share a little bit about, if you can't, the background noise. You know, earlier this morning we had a little bit of technical difficulties. I'm away in Buffalo meeting with colleagues from across the country for the New York Funders Alliance. And so here's when the best laid plans fail. Here's when the best laid plans fail. Hotel room not ready. The convening that I was participating let out a little bit earlier, so my quiet space has no longer become quiet space. So with all of that in mind, I still want to talk about the moment, right? The new normal. And so the new normal is helping all of us begin to think about flexibility, nimbleness. It's helping us think about the importance of collaboration and partnership and how those things really begin to drive what we're doing as a community foundation and what we're doing in this moment to build resilience. So in my short 8 months, what I've learned about the people that are assembled on this screen is that you are critical. You are important. You are our key partners that help enable the work that we do every day to build resiliency and vitality in our community. Without the work you do in partnership and in alignment with us, we couldn't do all of the wonderful things, one, that we do for strategic priorities for the organization, as well as help bring your clients, our donors, philanthropic ambitions to life. 900 plus funds today are here in place because of our partnership and work with each of you. And I cannot begin to, one, thank you enough for that partnership and collaboration, but also more importantly, the conversations that you are having with your clients about how we help bring their ambitions philanthropically to life. So a huge thank you, and a huge part of my 8 months onboarding has been my connection to many of you. And so I appreciate you. We appreciate you. The Central New York region needs you in your work with your clients because we have big things that we need to continue to accomplish together. So thanking you in advance for what you have done, and thanking you more importantly on all of the wonderful things we will do with you and your clients going forward. What we are about to hear from our distinguished speaker will certainly help provide the context and help give background to help you with your clients in terms of tax planning and thinking about charitable giving in even the broadest way that can be of assistance to your clients. So I have the distinguished honor to introduce today's speaker, Justin Miller. Justin is a partner and a national director of wealth planning at Evercore Wealth Management and managing director at Evercore Trust Company, where he works, keyword, collaboratively with accountants, attorneys, and other advisors to provide a comprehensive wealth planning advice to clients. Justin is also an adjunct professor at Golden Gate University School of Law. He's a fellow of the American Bar Foundation and a fellow of the American College of Trust and Estate Councils. If that weren't enough, he is also a frequent speaker at major conferences, has published numerous articles, and is regularly quoted as an industry expert in the media. Justin has received a BA with honors from the University of California, Berkeley, and a JD and LL.M in taxation from New York University School of Law. Please join me in welcoming Justin Miller. Justin?
All right. Well, thank you so much. Thank you to all of you for joining me this morning. Thank you to the Central New York Community Foundation and all these sponsors. So what I'm going to do today is first try to end on time. So I know we have till 2 p.m. Eastern. It's a little earlier here on the West Coast. But in that amount of time, I want to tell you everything you need to know about charitable tax planning. The first half, I'm going to go through some updates, some current cases, regulations that have come out. And then in the sort of the last 45 minutes or so, I'm going to talk about how do we actually get our clients and donors to implement some of these strategies. So the goal here is, first of all, we want our the people we work with, advisors, clients, donors, we want them to give as much as possible to charity, but it's not just as much as possible. We want to make it as tax efficient as possible. We'd rather, and most people would rather, see more money going to the charity in a tax efficient manner as opposed to that extra money just going to taxes. How do we get more money to charity? And then how do we get people to actually implement those strategies? So with all that as a background, why don't I just kind of dig in? If you see me kind of turning to the left, it's not that I get distracted easily, although I kind of do. I've got another screen to my left. I'm going to be looking for any questions. I won't be able to get to everyone's questions as I talk. I'll save a little time at the end, or you can always reach out to me afterwards. And just make sure you also pay attention to those codes that pop up. We want to make sure everybody gets their continuing education credits. And if you have to listen to me for 2 hours, you better at least get some continuing education credits. So with that, let's focus on what are we talking about here? Is this even a really important topic? Do people really give to charity? I'll share with you the latest Giving USA numbers. This is prepared every year by the Indiana University Lilly Family School of Philanthropy. So this is the latest 2024 report for the 2023 tax year, and we're looking at $557 billion going to charity. So more than $500 billion going to charity, and most of that still comes from individuals. 67%, $374 billion with the B, $1 billion going to charity. Now, one of the things that you'll see is that's interesting if you look at it over past history, recent years, and that is a couple things. One. For the first time ever, only a few years ago, did individuals make up less than 70%. For years, it was always individuals gave more than 70% of that big number. Now, it doesn't mean individuals are giving less. What it means is if we look at the other categories, foundations, corporations, bequests, they have increased at a greater rate than individuals. So they're making up a little bigger piece of the pie. So 2023, if you look at just the dollars, record year for philanthropy. But if you take inflation into account, now we all know we've had some big inflation. This is just the 2023 numbers. But if you take inflation into account, the charitable giving during the pandemic in inflation-adjusted dollars was still a little bit higher, but we're still a very, very charitable country. And so now let's talk about where are these charitable amounts? Why are they so big? Where does it come from? How do we compare to other countries? So let's just look in terms of the United States. Is a percentage of GDP, and this has been pretty consistent over many, many, many decades, depending on how you measure it, anywhere from, let's say, 1.6 to 2% of GDP, gross domestic product, every single year in the United States, between 1.6 and 2%. Once again, depending on how you slice and dice those numbers, that's pretty big. But what's really impressive is to look at how we do it globally. Compared to, let's say, the United Kingdom or Canada, we're talking about more than double. Only 0.73%. At the top of this chart, if you are looking for another reason to make fun of the French, there they are, 0.14%. So one of the less charitable countries. But now it brings up the question, why? Now, certainly there's a cultural aspect to it, but where are those dollars going? So we're clearly charitable in this country, clearly one of the most charitable countries in the world. Where are those dollars going? Now, most of those dollars, the biggest sector that we see is religion. Religion does make up the biggest category at 24% of all donations, if you look at it total. Now, here's what's interesting about religion. Only over the last few years has that number ever dipped below 30%. So what we see is, even though it's the biggest category, it's also quickly becoming a smaller and smaller year over year. So this is religious organizations. The other thing that's interesting, if you really dive deep into the religious category, is who's giving to religion versus all these other categories. Now, if you look at the numbers and the statistics, what we see is it's actually the lower net worth people tend to give a bigger portion of their charitable donations to religious organizations. So lower income people tend to give more of their charitable dollars to religion, whereas higher net worth people tend to give more of their dollars to all those other categories, especially education, arts, culture, humanity, things like that. All right, so why? Why? What does the research tell us? Why do we give? And this is really important to get to the heart of the matter. Why are we so charitable, not just in general, but especially in the United States? Well, let's talk with the first one. I think this is the best one. Psychological. Studies have shown that there's actually a causal effect. When you give to charity, it increases happiness. The same chemicals are released in your brain that you get from like eating a delicious piece of chocolate cake. I mean, this could be the diet plan of the century. Instead of, give money to charity, it has that same pleasure centers activated. So it causes happiness. For years, people thought there was a correlation, and they thought, oh, well, maybe happy people give more to charity. But the more recent scientific research shows the actual act of giving increases happiness. That's a great reason to give. The other reason studies do support, there's a social benefit, signaling your wealth or status. And that's why, especially in this country, most gifts are not anonymous. There absolutely is a benefit, whether it's your name in the program, whether it's on a bench, whether it's on a building, there's certainly a social aspect, signaling wealth or status, and that encourages or increases giving to charities. But for the rest of today, we're really going to focus on the third reason. And this also explains where we are from a global perspective. And that is, in this country, and also in many states, you get a tax break. And that's what we're going to focus on today. And tax breaks don't necessarily explain why you give, but it certainly helps explain the amount you give. So if you can give tax efficiently, it means more money to charity, bigger deduction for you possibly, and less money to the IRS or your state tax authorities. All right, so let's go through it. Once again, I'm just going to go, I'll kind of keep an eye on questions. I'm going to go quickly. My goal here today is to give you everything, really give you as much bang for your buck as possible in this short period of time. So first of all, let's talk about who actually gets a tax benefit in this country for giving to charity. Now, what happened with the Tax Cuts and Jobs Act of 2017, and I don't know if you remember, this was done at the end of 2017 in December, and Congress was rushing, and they, don't get me wrong, they spent dozens of minutes working on this legislation, which a lot of it is expected to expire and is actually automatically set to expire after 2025. We don't know what's going to happen with presidential elections, let alone the makeup of Congress. But right now, under our current law, only roughly 10% of this country gets any benefit for giving to charity. Now, don't get me wrong, if you look at the statistics, that's who's paying close to 76% of the taxes in this country, but these are the people that itemize for tax purposes. If you don't itemize, then you're not getting necessarily, we'll talk about some exceptions, but you're not getting a benefit of a charitable deduction because you're taking the standard deduction. Now, the reason right now it's only 10%, it used to be about a third of taxpayers got a benefit for giving to charity. The reason it's only in the top 10% now is, one, we have a much bigger standard deduction. It was almost roughly doubled with the Tax Cuts and Jobs Act. The other thing is when you look at why you would take more deductions than the standard deduction, charity is certainly part of it. Mortgage interest deduction might be a part of it, but right now you're limited only to interest on a $750,000 mortgage. The other reason is state and local taxes. It used to be we would deduct all of our state and local taxes, especially high tax states like California, New York. Those were income taxes. It could be property taxes. Now you're limited to $10,000. So if we add up our major deductions, let's say property taxes, state income taxes limited to $10,000, mortgage interest deduction limited to $750,000 or interest on that amount, and last but not least, charitable, most people in this country aren't exceeding the standard deduction, so they're not really getting a tax benefit for giving to charity. So what do we do about that? What about the people who are right on the cusp? They give to charity every year, and sometimes big dollars. I mean, we might be talking about $10,000, $15,000 a year. Why are they not getting any tax benefit? What can they do if they're right on the cusp of, do I itemize? Do I take the standard deduction? Well, for those people who are right on that borderline, what maybe they want to do is what we call bunching. What we might want to say is, rather than let's just take the next 3 years, let's assume the Tax Cuts and Jobs Act doesn't expire and then they renew it at least for a term of years. What should we do? Well, what we can do is, rather than taking a deduction every year, let's say for the next 3 years, why not give that money away this year, 2024? And the idea is, it doesn't mean you have to have it go to the ultimate charity this year. It could be as simple as setting up a donor advised fund, but put that money in a donor advised fund. And then for the next 3 years, the next 5 years, the next 10 years, whatever it is, then you can spread out the gifts to the ultimate charity, but you're getting a charitable deduction this year. Let me walk you through in real numbers. So let's just say you've got sort of your donors, the clients you're working with, they've got some state income taxes, they've got some property taxes, it's let's say $30,000 combined, but we know you're limited to only taking a $10,000 deduction. And they also, let's assume, have some mortgage interest and they make charitable gifts of $10,000 every single year. That's so nice that they're giving money to charity. We love that. That's great. But they're not getting a tax benefit. That's a shame. How could they rearrange this a little bit? Well, instead of doing $10,000 in charity every single year, what if instead they combined it and gave that $30,000 away this year? Now, it doesn't mean it has to go to the ultimate charity. Maybe they set up a donor advised fund this year, a DAF. But when you do it this way, they will get the benefit of the tax deduction in 24 this year if they give the money away, because they're going to itemize in 2024. And here's the best part. Assuming, let's say the law just stays the same, we don't have the expiration or the sunset of the Tax Cuts and Jobs Act, they continue to take the standard deduction. So they're in no worse position in 2025 or 2026, but they're in a significantly better position in 2024. So great plan for those people who are right on the cusp. Do I itemize? Do I take the standard deduction? Why not get the benefit of both? Accelerate those deductions to this year. All right, now you might be thinking, hey, why do we make it this complicated in the tax code? Why don't we just let everyone get a charitable deduction on top of the standard deduction? Now, don't get me wrong, I would love that. That would be incredible. I'm sure a lot of us would be in favor of it. I will give you the percentage chances of that happening, and it's somewhere around roughly 0% chance of that happening. Standard deduction and a charitable deduction on top. There has been proposed legislation over the years. They're saying, when we talk about itemized deductions versus above the line, meaning let people get this charitable deduction in addition to the standard deduction, or maybe we even limit it up to a maximum amount of a third of the standard deduction. Now, why don't we allow this? Why isn't this good tax policy? And the reason why, frankly, it's just way too expensive. By allowing a charitable tax deduction, what the government is doing is giving up tax dollars. And allowing a deduction on top of the standard deduction would cost the government tens of billions of dollars a year. So it's unlikely we're ever going to see this put into our legislation anytime soon. Now, during the pandemic, we did get a very, very tiny version of this. And I'll just kind of share with you. At one point, we had this $300 CARES Act deduction. It was kind of extended in 2021 and allowed both spouses to do it for $600. But in the first iteration of it in 2020 during the pandemic, this is exactly what the government did. It said, you know what? Let's let people who take the standard deduction also get the benefit of an additional $300. So not enormous, but it certainly was a record year for giving to charity, adjusted for inflation. Now, why was this expensive? Well, think about it. 41.4 million taxpayers, more than 25% of all non-itemizers took this $300 deduction. What does that mean? It means it cost the government over $10 billion in lost tax revenues because 41 plus million people took this deduction. Now, the other challenge is, did they really give that money to charity, or did they just check the box on their tax return and say, oh yeah, give me an additional $300? I don't know how many people were audited for owning a $300 gift. So that's the other challenge as well. Are people claiming this deduction and not actually giving the money to charity? I certainly hope not. It's a shame. I hope people really did give that extra $300. But the point is, we're very unlikely to see a charitable deduction on top of a standard deduction, which means to get the benefit, we need to itemize. All right, now let's talk about what assets you're giving to charity. Most gifts in this country, not dollar figure, but amount of people giving in general, most people give in cash. And don't get me wrong, it's great that you're giving it all, but if you want to be tax efficient, think about using appreciated property, especially appreciated securities, your stocks that you own, stocks that have gone up, whether it's NVIDIA, Apple. You've got this big appreciation in your stocks. Give that to charity. And I'll tell you what, if you have been investing for the last 5 or 10 years and you don't have something that's appreciated in value, it means you probably need a new wealth manager. At this point, you could have picked stocks over the last 10 years by throwing darts at a dartboard. You should have something that's appreciated in value. So why give stock versus cash? And if you look at some of the major donor advice funds, even with that, anywhere from, depending on the fund, 87 to 93% of gifts, once again, not dollar figure, but number of gifts, anywhere 87 to 93% are made in cash. They're still made in cash. Why do we want to use stock? So I'll tell you what happens. Usually what happens is, even when people have investment managers, they call up their investment manager and they say, hey, I need you to sell some of my stock. I need $200,000. And what would happen is, let's say it's appreciated stock. In order to generate $200,000, it means, let's say in this example with appreciated securities, they would have to sell $250,000. The client or the donor would get hit with a $50,000 tax, and then they would have $200,000 left to give to charity. But what if you just ask, and this is where good advisors come in. This is the difference between, look, a good advisor, they hear from their client or the donor and they do what they're told. I should say a really good wealth manager asks another question and says, happy to do this for you. They're very responsive, but ask why, because maybe there's an additional value. And if somebody says, oh, I need that money, I'd like to make a charitable donation, don't write a check to charity. It kills me when our clients, I don't ever want to see a client write a check to charity. Don't get me wrong. I love it when they give to charity, but don't write a check. If you have appreciated securities, give those appreciated securities directly to charity. As long as they're long-term, you've held them for more than a year or so, then why not give the securities to charity? If you do that in the same example, let's say you were to give the $250,000 instead of selling it right to the charity, what happens? You get a full $250,000 deduction. You don't pay any capital gains tax. Zero capital gains tax. And do you think the charity cares whether there's capital gains? No, the charity doesn't pay any capital gains tax. So you've got more money over to charity. You saved $50,000 in capital gains tax, and the cherry on top, you got an additional $50,000 deduction because you gave the full fair market value, $250,000. This is a triple win. You've got saving capital gains taxes, you're giving more money to charity, and then number three, you get an additional deduction. The only one that loses here is the IRS, and they're okay with it. It's in our code. Our Congress said you can do this. So once again, always think about appreciated stock to charity. We're going to talk about an exception in a little bit with trusts, but in general for individuals, think of appreciated securities. And if you're dealing with a charity, let's say, that doesn't accept stock, or they don't know how to accept stock, or a smaller charity, there's an easy workaround. Create a donor advised fund. Put that appreciated stock into that donor advised fund. And guess what? Once it's in there, you still get that same $250,000 deduction. There's $250,000 sitting there. It will continue to grow tax-free in the donor advised fund. And then you can use that money to send your checks to charity. All right. Where are people making mistakes? What are some important reminders? So let's say you are itemizing. You want to take advantage of your charitable deduction. You've got to do it correctly. You have to do it correctly. If you take anything away from today, if you're going to write something down or put an asterisk or highlight anything, it's do it correctly. The problem is, if you give to charity and you make a mistake, you don't follow certain rules, you get zero deduction and there is no way to fix it after the fact. So the first thing we have to think about is any gift of $250 or more. Any gift of $250 or more, you have to have what's called a contemporaneous written acknowledgement. So if you want the acronym or the abbreviation, CWA letter. Contemporaneous written acknowledgement. And now often you've probably seen this, or you hand it to your accountant at the end of the year, and charities generally do this automatically, and it says whether or not you've received something in return, where any goods or services received. Most of the time you're just writing a check or giving securities or whatever it is. You're not getting back anything in return other than positive psychological benefit. It doesn't count if your name's put in on a building or on a bench or in a booklet. That doesn't count as getting something in return. What they're really looking at, was there any quid pro quo? Most of the time there's not a quid pro quo, but that letter has to say whether or not it happened. The letter has to say, was anything received? All it has to say is, no goods or services were received in connection with this gift. Some charities, you'd be surprised, not just sort of tiny nothing charities, but, that are just startups or anything like that, but even some, significant charities, they forget to put that sentence in there. And if they don't have that sentence in there and it's more than $250, $250 or more, zero deduction and zero way to fix it. For a donor advised fund, it also has to have a special statement. It's that it has exclusive legal control over the assets contributed. It has to have that statement. And you have to get the CWA letter before the earlier of when you file the return or the due date, including extensions for the return. If you don't do this correctly, zero deduction, zero way to fix it. And I'll give you, I'll walk through some of the more recent cases in a little bit, but some of the older cases involved, and by the way, this happens every year. It almost seems like clockwork. There are several of these cases every year, and these aren't just tiny, small charities. These are wealthy taxpayers with major charities making these mistakes. And so I'll just give you an example. There was the Durden case. This was a guy, I'll give you the example. Let's just say you have someone and they're giving to their synagogue or church or whatever it is, and they absolutely are giving that money, and we have checks, we have absolute proof, and they get a letter in return that doesn't say whether or not goods or services were received. Person files the return, takes their deduction, it could be thousands of dollars. And let's say we have absolute proof that that person donated to charity. We've got the bank records. We can see the money going from that person's account into that synagogue or church's account or whatever it is. We've got the minister, the priest, the rabbi, whatever it is, filing an affidavit after the fact saying, I promise you, we never gave this person anything in return. We received the money. There were no strings attached. We 100% say that, this money went through. The problem is, if you don't have that CWA letter with that special language by the time you file with extensions, guess what? Zero deduction and zero way to fix it. The donor advised fund case, there was another one recently where these business owners, they're selling their business and they donate to a donor advised fund. And the donor advised fund had given them all this information and attachments. And in those sort of collateral information in their brochures and all that, it said the donor advised fund would have exclusive legal control over the assets contributed. But guess what wasn't in the CWA letter? It didn't have the language in the CWA letter, and that CWA letter did not have that collateral material attached or referenced. So what did the IRS say? Zero deduction. You didn't get the appropriate CWA letter in time. We know you made we absolutely know you made this charitable contribution, but because you didn't have the CWA letter with that special language, no deduction. So let's just make sure everybody, you do this right. There was another one. This person had a 5-page gift agreement with the charity. 5 pages, clearly was working with advisors, very, very detailed. 5 pages, gave 120 items to charity. 120, this is the Alpert case, 120 items. We know they gave it to charity, but what wasn't in the 5-page letter? It didn't confirm whether or not there were any goods or services received. Now, there weren't, but because they didn't get the complete letter in the appropriate amount of time, zero deduction for this irrevocable permanent gift to charity. Don't make this mistake. The other mistake, what about the bigger donations? Anything more than $5,000? If you're giving anything other than, let's say, cash or publicly traded securities, you've got to do what's called a qualified appraisal. The rules for qualified appraisals are very, very strict. It's got to be done by a qualified appraiser. There's experience and education requirements. If you don't do this correctly, zero deduction. We'll go through some recent cases, but I'll even bring an example up. And there was a, I'll use the Mohammed case. There's a real estate guy and he does valuations, all the time. He's in real estate and he's going to set and make a big gift to charity. And he's thinking, oh, you know what? I'm going to give $19 million of real estate to charity. And he appraised it. And the IRS eventually came back and they said, hey, where's your qualified appraisal? And the guy said, oh, I do appraisals all the time. I was very conservative. I did a $19 million appraisal. I'm taking a $19 million deduction. The IRS said, oh, you can't do it yourself. That doesn't count as a qualified appraisal. Even if you are an appraiser, you can't do your own. And so the guy said, fine, I'll go out and hire someone. I was trying to save money, but since you're such sticklers for the rules, let me go out and hire someone to do the appraisal. The appraisal came back and actually said, hey, this guy was being conservative. It's worth more than that dollar figure. It's worth more than 19. You're very lucky he was so honest and forthright. In fact, even some of those properties, they eventually sold for more than $19 million. You have absolute proof this guy made a donation and the donation was worth, at a minimum, what he said it was worth, $19 million. So how much deduction did he get? The answer is zero. He got zero deduction. Why? Because he didn't get the qualified appraisal in the appropriate amount of time. If you don't do this correctly, zero deduction. Now remember, this gift is made, it's very nice, but you get no tax benefit if you don't do it correctly. So with all that as background, let's see some of the more recent cases. Some of these deal with, as you'll see, there's a theme with conservation easements. These aren't necessarily those like dirty, syndicated conservation easements with abusive tax shelters and all that. But a lot of these are pretty bad overvaluations. And what we'll see is not only did they mess up and not get any charitable deduction, but you're also going to see if you do it wrong and you do it really wrong, you get a misstatement, a gross valuation misstatement penalty of 40%. Talk about adding sort of salt to the wound here. Not only did they reverse your deduction, but they're hitting you with a penalty of 40% on that misstatement. So let's walk through one of these. So this is Brooks v. Commissioner. They bought this property for $1.35 million, and they put an easement on a little bit less than 1/2 of the property. So first of all, they reported it incorrectly. They should have said the basis was not 1.35. It was supposed to be, let's say half the property, $652,000. So they did their reporting incorrectly. The other thing is, now remember, look at these facts. They bought the property for 1.35. On half of the property, they did an easement, and we know we can do conservation easements. How much was this easement on half of the property worth that they bought for 1.35? So the basis on half is $652,000. Well, they took a deduction for $5 million. $5 million. And then what happened for the court? And the court said no contemporaneous written acknowledgement. No contemporaneous written acknowledgement. Why? Because they just, for what they filed, an easement deed that went back to them that just proved they made the deduction. It didn't say whether goods and services were received. $0 deduction. Now, they really did put an easement on the property. $470,000 is what it was valued, but they didn't get any benefit for that easement. Now, they way overvalued it. Remember, they bought it for 1.3, and on half the property, they're now taking a deduction of $5+ million. It was so overvalued for charitable purposes that they got a 40% gross misvaluation penalty. It looks like there's a question here. I'll just look at it real quick. Gift of stock is anonymous. How does charity send an acknowledgement? Brokerage account. This is where, by the way, so what about, you do have from time to time anonymous donations. The reality is, even with an anonymous donation, it doesn't have to have, this is where donor advised funds really work very, very well. That you get your donation, give it to the donor advised fund first. And then once it's in the donor advised fund, there's a box you can check, because a lot of people, and I get it, they don't want to be on the mailing list. They don't want people coming back to them. They don't want them having their information. And they just say, look, I want to support these charities, but I don't want them coming after me for more. And I get it. And these are a lot of our clients, and that's so nice they're willing to give. Use a donor advised fund. There's a box. Make sure you pay attention to it. You check the box. You can have it come from your donor advised fund. It can be, in my case, we've got the, Justin and Marianne Miller Foundation, even though it's not a big private foundation, but the charitable gift fund, whatever you want to call it. But if we don't want someone to know our names, it's already, we got the deduction, and you can check the box for donor advised funds. But let's move through. We've got some more cases to go through. Corning case, here's another one. You can see these were really, really bad. These were really bad facts, but it still gets back to, did they do a contemporaneous written acknowledgement correctly? And did they do a qualified appraisal correctly? So what was going on in Corning Place? This is another recent case, July 2024. So the taxpayer bought this 11-story historic building and 8 other parcels for $6 million. $6 million for 11-story, all these other parcels, and then got this special kind of rehabilitation plan. They had federal and state tax benefits. And part of the deal for these federal and state preservation tax credits, no rooftop improvements visible from the street. So they bought it for $6 million plus some other properties. And here's what they got some tax benefits to kind of fix this hotel up, this 11-story. And what did they do? Well, they turned around and said, okay, well, in theory, we could build a 34-story vertical addition on top of this historic building, and we're going to give up our right to add 34 stories to this 11-story historic building, and we're going to take a $22.6 million deduction. Now, remember, they bought it for $6 million, and they're saying we're giving up the right to do an additional 34 stories, and we're going to take a $22.6 million deduction for it. Well, what did the court say? The court said, look, apart from being structurally implausible and economically unsound, basically, there's no way you're going to add 34 floors of steel and concrete to this building, especially because you had this arrangement to get these federal and state tax benefits that didn't even allow it. And therefore, and there were some other issues they did wrong. So not only did they not get the deduction, gross misvaluation or gross valuation misstatement penalty of 40%. So once again, not only do you not get this deduction, you didn't do it correctly, but a 40% penalty on top of it. Another very similar one as we move through, this is Lake Oconee. Oh, someone asked, what time frame constitutes contemporaneous? And this is where we get back to, if you go back to that other slide, written contemporaneous acknowledgement, or CW, contemporaneous written acknowledgement, contemporaneous CWA letter. It's got to be when you file your tax return, or no later than filing your tax return, the extension date for filing. So basically for this year, October 15th, if you filed on October 15th, that was the date you had to have it. But if you filed back in April, you had to have it by April. So for 2024, people are filing in April 2025. If that's when they file in April, that's when they need that letter. If they do an extension and file in October of 2025, then they'll need the CWA letter by then. Okay, what was going on with this Oconee Landing? This is beautiful property, this lake out there, golf courses. It's this area of Georgia. And so the landowners had they still had part of this property, and they were trying to sell it for 2 years for less than $10 million. So for 2 years, they could not sell this for $10 million or less. So what did they do after 2 years? They said, oh, some people came in and said, what if we were to turn this into a conservation easement? And so they went out and these people packaged these deals and they're very, very aggressive. And they said, even though you weren't able to sell the land, nobody wanted your land over the last 2 years for 10 million. What if we made it a conservation easement and we gave it a $60 million value and we value your easement at 20.67 million? So the idea is they're putting an easement on property they couldn't sell for 10 million. And now they're saying not just the land, but the easement for the land is worth more than double what they couldn't even sell the property for. So what did the court say? They said, look, this is not a qualified appraisal. Part of this whole deal was they kind of backed into the $60 million value. They said, how much of a deduction do you want? And we'll figure out what the value should be to get you that deduction. The other thing is they kind of threw the book at the original landowners and they said, hey, I understand you were working with these unscrupulous advisors and all this kind of stuff, but you had to have known your property was worth less than 10 million because you couldn't even sell it for 10 million or less than 10 million. How did you feel appropriate to take such an enormous deduction? Didn't $60 million valuation seem outrageous or egregious if you knew you couldn't even sell it for 10? So anyway, they ended up getting a 0 deduction. Now remember, they put a conservation easement on this property. The court even valued it at somewhat less than $5 million. So if they did it correctly, this $10 million piece of property, they could have gotten a tax benefit doing it correctly for somewhere around the real value of closer or less than 5 million. But because of this extra or the mistakes they made and this way overvaluation, not only did they not get any tax benefit for the deduction, gross valuation misstatement penalty of 40%. All right, this one's a fun one. Bass v. Commissioner. Some of you might, try to be creative, and from time to time, we see donors or clients that you're like, hey, can I come up with my own workaround? And they might say something like, look, Justin, gosh, what a pain to do all of this. You already told me I've got to do the CWA letter if it's 250 or more. And oh my gosh, I've got to do a qualified appraisal if it's more than 5,000. What if I just did lots of little gifts? I just kind of spread it all out. And that's what happened in Bass v. Commissioner. He was donating clothes to charity. And instead of having to get a qualified appraisal and CWA letters and all this, what he did is, or at least claimed to do, is he said, I made 173 separate trips to Goodwill and Salvation Army, sometimes on the same day. Now, I don't know if this guy's telling the truth. Maybe he went, maybe he just got a stack of those receipts and kind of changed the dates on them. But apparently, when he had lots of records, he said, I gave all this property in good use condition away. I made 173 trips, and each one of those trips, less than $250. So I don't need a CWA letter. I don't need a qualified appraisal. But what did the court say? What did the IRS argue? And they said, look, I don't care that you made 173 trips. This is all similar property, and therefore we have to aggregate them. And in this case, it equaled more than 5 times the amount, more than $25,000 if you combine all these clothing gifts. You needed not only the CWA letter, you needed a qualified appraisal. You didn't do it correctly. So guess what? 0 deduction, because not only did you not do it correctly, you didn't get it done in time. After the fact, a year or two later, it's too late. Even a day later, it's too late if you don't do it correctly in time. Other mistakes that people made. So we went through some of the unscrupulous people, but what about just honest mistakes? People just, didn't think things through. Maybe it wasn't the best advice. Maybe it wasn't clear under the law. Let's look at the warning case. So the warning case was, this was an estate that, the decedent, the person died, and he wanted an LLC. This is worth lots of money here. And there was 100% of this LLC was owned, and wanted it all to go to charity, but picked 2 different charities. And the decedent, before they died, they said, look, 75% of this LLC goes to my foundation, 25% goes to the church. So we absolutely know 100% of this LLC is going to charities. The problem is it's going to more than one charity. So it doesn't matter that 100% ends up with different charities. The problem here is the interest was broken up into more than one charity. And anytime you break up an LLC or a partnership or anything like that, you start dealing with what are called lack of marketability discounts and lack of control discounts. Now, in the estate planning world, we love this. This is the bread and butter of estate planning. When you're setting things up for kids and grandkids in trusts, we love discounts. Valuation discounts is the heart of estate planning, trust and estate planning for kids, grandkids, and beyond. But you don't want a discount if you're giving something to charity. You want the biggest deduction possible for giving to charity. And so unfortunately, in this case, the court said, now it was a good result for the gifts that were made to family members, but a bad result for that charitable deduction. Why? Because it had to be discounted. Now, had this decedent just left 100%, let's say, to the foundation, and then the foundation made a 25% gift, that would have been fine. But because they split up this LLC, what they did is they actually created a discount, which meant smaller deduction. So in general, we don't want to do this. Be very, very careful splitting up sort of interests and things like LLCs and partnerships in creating an unnecessary discount. All right, the Hohenscheid case, this is a big one. This is pretty recent. And this deals with what's called the assignment of income doctrine. And remember, I was telling you that's great, donate appreciated securities, get a full deduction, full fair market value deduction, pay no capital gains. That's the general rule if you own IBM or Microsoft or Apple or any kind of sort of publicly traded stock. But what if you own your own company? You can still donate your appreciated shares or ownership in that entity to charity and avoid capital gains. But you have to be careful. If there's a pending transaction and you're too close in time to the end or the closing of that transaction, you don't avoid capital gains. You got to do it before it looks like you're too close to closing. Now, the assignment of income doctrine, this came from the famous Lucas v. Earl case. We have some lawyers in the audience. You'll probably have flashbacks to law school. This was the famous, Justice Holmes, could have been a poet. He said, fruits cannot be attributed to a different tree from that on which they grew. Meaning, look, if it's pretty much a done deal that you're going to sell this business and you can't avoid the capital gains on it, you still have to pay the capital gains. But if you do it far enough in advance, you can give it to charity, and the charity will be, charities don't pay tax on capital gains. You'll avoid all the capital gains. So what happened? Let me walk you through the timeline. The problem is, how far in advance do you have to go? We don't know. There's not like an exact percentage or timing, but if it looks like it's virtually going to close, it might be too late to avoid capital gains. So what was going on? Let's flash back. It was 2015. Here are these three brothers. They're grandchildren of the founder. And someone sends this letter and says, hey, we'd like to buy your business for $92 million. This is all in April. One of the brothers is charitable. He says, hey, you know what? He's talking with his attorney. He's like, hey, this is great. I can give part of my business to charity, and I can avoid tax on that part of the business, and I'll get a full fair market value deduction. Now, the attorney didn't give the actual correct advice. It was close, but the attorney said, hey, you just got to do this before you have a definitive agreement. That's not the test. That's not the test, but at least the attorney was sort of thinking what I'm telling you, and that is, hey, be careful of this assignment of income doctrine. If it's too close to closing, you're not going to avoid the capital gains. So April, we're still in April, and the donor emails back. And by the way, this all came out through discovery. So people find these emails. The donor said, I would rather wait as long as possible to pull the trigger. If we do it and the sale does not go through, I guess my brothers could own more stock than I. So I don't know about the family dynamic here with the brothers, but clearly in April, this guy could have given to charity, and there's a real risk that this deal might not close. So we know at that point, this is a pretty good bet that he could have given that some of those shares to charity and could have got a full fair market value deduction. So then in April, they sign it. Still a non-binding letter of intent. It's not binding. There's still due diligence. Now let's flash forward to June. So by June, he still hasn't given anything to charity. He says, I do not want to transfer the stock until we are 99% sure we are closing. Now here's a problem. We don't know when the assignment of income doctrine kicks in, but if you're 99% sure you're closing, that might be too late. I don't know whether 98, 97, but 99% seems too late. And let's see what happened. There was still due diligence going on. The corporation approved a gift. They said in June, look, if you want to give to charity, go for it. We approve it, but they left it blank. And then some more due diligence happened. There were some July. So now we're in July. Donor still doesn't know how much he wants to give to charity. Now, he could have done it back in April. Arguably, he might have even been able to do it in June, but now we're in July. So what's going on in July? Well, in July, it's pretty much a done deal. Why? The company approves this plan. It says, okay, let's just get rid of all the excess cash. We've got this revised purchase agreement. It's 99% there. There's just some, minor administrative issues that they're working out. And then finally, they kind of figure out a dollar figure or amount of shares that this donor would give to charity. All this stuff happened. And when did the actual gift to charity kind of theoretically go out? July 13th. July 13th, you actually get this undated stock certificate, but it looks like July 13th is when you made the gift to the donor advised fund. Transaction closes 2 days later. We have final drafts, so it was pretty much a done deal. Now, here's what happened with the donor. The donor goes and says, and when doing the tax return, says, hey, and the donor advised fund gave them this confirmation letter and said, hey, thanks for your donation on June 11th. Now, if you're looking at this timeline, you would say, wait a minute, they didn't actually give anything to the charity until July 13th. Why is it dated June 11th? June 11th certainly would have been a better time to give, but that's not when the actual gift was made. So what happened to this donor who was trying to take a $3+ million deduction and avoid capital gains on the transaction? Well, the court basically said, absolutely not. No avoidance of capital gain. This is assignment of income doctrine. It was a virtual certainty when you made this donation that the deal was going to close. They looked at the reality and substance of all the circumstances, not just whether or not it was the charity had to sell or things like that. They looked at all of it. And when you looked at all the circumstances, it was virtually certain it was going to close. So in this case, the taxpayer got no avoidance of capital gains taxes. But it gets worse. The question is, okay, well, you didn't avoid capital gains taxes, so you still have to pay capital gains on the sale. It's almost like you sold the stock and then gave the cash to charity, but do you at least get a charitable deduction for what you gave to charity? You didn't avoid capital gains, but what about a charitable deduction? And this is where that taxpayer made another mistake, getting back into qualified appraisals. Now, I don't know this person, I don't know what they were doing, but it sounds to me like, I hate to say it, maybe they were trying to be cheap. Maybe they were trying to save money and they said, well, I don't want to go out and pay for a qualified appraisal and get a real qualified appraiser. Can't I just get the guy who's helping me out on this deal to give a rough estimate of what the stock is worth? Boy, I could save, maybe thousands of dollars to just kind of use, and maybe they won't even charge me as a favor. I'll just get this guy to give me a valuation. Well, the problem was, it wasn't a qualified appraisal. A qualified appraisal has to be done by a qualified appraiser. There's education and experience requirements. There's special things they have to say in the appraisal. And the other thing is, in the appraisal that they used, not only was it not a qualified appraiser, but they didn't even get the right date on the appraisal. They failed to take into account all these things that happened prior to the gift. And for that reason, not only did you not avoid capital gains taxes, but $0 deduction for what you gave to charity. Now, don't get me wrong, this donor advised fund was filled up with around $3 million. Certainly, money went to charity, but because they did it incorrectly, they had to pay full capital gains on the sale of the business on the part that went to charity, and they got zero deduction for the proceeds that went to charity. So be very, very careful. All right, we've talked a lot about stock and business interest. Let's take a look at retirement accounts, traditional IRAs. One of the best things, the best assets that people can leave to charity, IRAs, your retirement accounts. And the reason why it's the last asset that your loved ones want to inherit. The reality is, look, often your loved ones want to inherit any asset they can get. I mean, that's nice. But if they had to pick and choose, a traditional IRA or a 401k or a 401k rolled over into traditional IRA, they're subject to ordinary income taxes at the whatever your highest could potentially 37% rate at the highest tax rates. So if you're thinking about what can I leave to charity at the end, always think about things like IRA. So let me kind of walk you through an example. We had a client, I changed the numbers around a little bit, but you had a woman who in her mind, she said, you know what? She'd already made some gifts to her child and she thought, okay, well, what if I left my stock to charity and I left my IRA to my child? And that was kind of her plan. In her mind, they were roughly about the same dollar figure. But when we actually showed her the end result, we said, okay, I mean, you could do it that way, but here's the problem. When your son gets that $1 million, your son's going to have to pay federal and state taxes on that $1 million. And now we have the Secure Act, and maybe you have 10 years to take it out. But when you take it out, you will be subject to ordinary income taxes. So that means the child's going to end up with, let's say, 550,000 of the million. Charity ends up with the full million. They don't pay taxes. So we said, what if we switched your thinking a little bit? Instead of leaving your stock to charity, what if you left the stock to your child and you left the IRA to charity? So we switched it up a little. The charity ends up in the exact same position. Charities don't pay taxes. So in this case, the charity gets the $1 million. You leave the charity there, and the child's in a better position. Why? Step up in basis. The capital gains disappear when you die. The child can get the stock, turn around and sell it the day after you die for $1 million. They get 100% of that tax free, instead of the IRA that they'd have to pay full ordinary income taxes on. This is very, very good planning. And by the way, so easy to do. So if you're ever working with clients or donors, always look at the IRA as an asset if you're talking about what to do after death. And it's very easy. You just change your beneficiary designation. You don't have to change it depending on what wealth management firm you're working with. Some are more flexible than others. The smaller ones or boutique RIAs might be even more flexible. But the idea is you don't have to leave the entire IRA to charity. You can pick a portion of it, or you can split it equally amongst your children and charity. You don't need necessarily a lawyer. This is not, constantly going back and forth and amending your trust agreement. It's simply a beneficiary designation form. But that's after you die, what you're leaving to charity. What about giving to charity while you're still alive through your IRAs? So we have what's called some people call it a charitable IRA rollover. A technical term is a QCD, or a qualified charitable distribution. But this is if you are 70 and a half or older, you are able to take a certain amount out of your IRA every single year, and you can give it directly to charity. And if you're subject to RMDs, so remember, it starts at 70 and a half, but if you're subject to RMDs, which right now starts at 73, you can actually treat, if you don't need that RMD, you can treat your RMD as part of that QCD, meaning instead of having to take this into income and paying ordinary income tax, you can send that RMD directly to a charity. Now, a couple qualifications. One, you can't do it an unlimited amount. What's really nice is the Secure Act 2.0 that we just passed this year. It's adjusted for inflation for the first time. It was set at $100,000 for years. They kept extending it retroactively. Now this is a quote unquote permanent rule that you can give to charity. But what happened just in this last year is it's now adjusted for inflation starting in 2024. So now you can do up to $105,000 every single year directly to charity. Now, you don't also get a charitable deduction, but the numbers work out better. First of all, not everyone itemizes. So if you take this into income and you get your RMD and then you write a check to charity, you won't even get the benefit of the deduction if you don't itemize. But even if you do itemize, it's not a perfect wash if you take something into income and then give money back out to charity. Certain percentage limitations and deductions, things like the net investment income tax, that 3.8% tax. By bringing something into income, you're increasing your overall income, modified adjusted income. So what's going on at that point, your modified adjusted gross income has gone up, which means even though you turned around and gave it to charity, you're still paying an extra 3.8% tax on more income. So the problem is it's not a perfect wash. The efficient thing to do is to say, hey, let's have it go directly from this IRA to a charity. Now, if you do this, you got to make sure that your accountant knows. Most places, it depends on who you're working with. Some, like I said, some of the, more up-to-date wealth managers, they will actually write on the 1099-R. There's no line to say there was a QCD, but there might be a footnote so that the accountant can at least know a charitable donation was made from this account or it went directly to a charity. But there's no checkbox or line that specifically tells your tax preparer that you made a QCD, a qualified charitable distribution, which means your accountant has to specially go into the tax form, your filing, and actually write it in on your 1040. Yes, an RMD came out, but a QCD was made. So we've got to be very, very careful. Make sure your tax preparer knows. The other thing is, unfortunately, and we're big fans of donor advised funds, but you can't do this with a donor advised fund. The rule is it has to go directly to roughly a public charity. There's some exceptions for private foundations, but the money has to immediately kind of go out. But the idea is it's got to go to a public charity. But once again, for people that are getting RMDs that don't really need RMDs, they're charitable, this is a great way to give during life. All right, what about this other new thing you might have heard of, this Legacy IRA Act? This came in, and people have been working on this for decades. This is a great idea. I'm in favor of it. Legacy IRA, really, it's just a change in form. And they're like, well, instead of having an IRA, can I change the form into like a charitable remainder trust or a charitable gift annuity or something like that? And look, I'll still get the money for the rest of my life. I'll still pay income tax on it, but at least I'm guaranteeing whatever is left for charity. Now, the reality is, I just told you earlier, you can just do with your IRA. You can just change the beneficiary designation whenever you want, and you can change your mind every single day if you really wanted of what charity or if you want to give to charity. But let's say you're ready to permanently make a choice. I want to change this into a Legacy IRA. Well, originally we were asking an unlimited amount, but then the original proposal was for $400. What was actually passed was this limit of $53,000. Really, this is just Congress and our government saying, hey, let's test this out. It doesn't really cost the government anything, because this is money you were otherwise going to get anyway over your lifetime. You're just kind of changing the form. You're still going to get it. You're still going to pay taxes on it. What you're really saying is whatever's left is going to charity. And you can do an amount up to one time. So it's $53,000. It's been adjusted for inflation. It was $50,000. So you can do instead of a qualified charitable distribution, just say, oh, give this $53,000 to charity. What you're saying is, wait a minute, I might want that $53,000 over the rest of my life. I still want it to end up going to charity in the end. So instead, you could do a charitable remainder trust or charitable gift annuity. Now, we'll talk about charitable remainder trust in a little bit. That's way too little money to go to the trouble of doing a charitable remainder trust. I can't imagine anyone's doing a charitable remainder trust with $53,000, just the filing and administrative, but it could be an interesting solution for a charitable gift annuity. For someone that, yeah, you could just give the money outright to a charity with a QCD, but by doing a charitable gift annuity, you're giving the money to the charity, but the charity is going to pay you back for the rest of your life. So instead of having an IRA, you're going to have a gift annuity that pays you back. So you're kind of in the same position. You don't really get too much additional benefit, but you do benefit the charity. So that's why a lot of charities like this. It just doesn't do too much for the taxpayer. And for high net worth taxpayers, just easier to do the QCD. Do they really need this money back? Why are you going to the extra trouble? All right, now we talk about charitable remainder trusts. These are still great strategies. There's charitable remainder unit trusts, which give a percentage every year, and there's charitable remainder annuity trusts, which give a dollar figure. Don't think of it as somebody going out selling you an annuity. We'll talk about that in a second. But no, these are in the code, in the Internal Revenue Code. We know we can do these transactions. There are people that have been tried to abuse them. We'll get to that. But the idea of a CRAT is it used to be not possible for certain people to even do a charitable remainder annuity trust when we were in a lower interest rate environment. Now there's sort of a safe harbor. There was a revenue procedure came out in 2016 that you have your choice. You can do either one regardless of your age, as long as you kind of say, look, if we ever fall below 10% of the value, based on this sort of present value calculation, whatever's left will go to charity. But why would you do one versus the other? The reality is when you run the numbers, the charitable remainder unit trust, meaning a percentage, typically will give the person who sets it up more money back over their lifetime. So when you run the numbers, most of the time, CRUT, the unit trust percentage, gives that person back more money over their lifetime. But some people just want to rest easy and they say, look, I understand that, but if the market goes up or down, my percentage number that I'm getting could go up or down. I just want to know I get the set dollar figure every year for the rest of my life. I don't care. I don't want to take the risk. Well, in this case, if that's what you're looking for, the CRAT could be a better result. Just to give you the numbers of my experience, of the last 100 CRTs that I've worked on, only 2 of them were CRATs versus a CRUT, but it's important to know that you can at least do it under the age of 74 under the new safe harbor. All right, since we're on the topic of charitable remainder trust, let's go through some of the things we have to be careful of. Now, just be careful if you try to get too fancy. As I said, the charitable remainder trust, it's in the code. This one's actually kind of a shame. I think it's the correct advice from the IRS. It's a very technical analysis. It's just too bad. So in this case, what was happening is the taxpayer is saying, hey, I want to set up a CRUT, provide money back to the person for life. It's got to be a minimum 5% payment. You can always do more. And then whatever's left goes to charity. And a lot of taxpayers think, well, you know what? I don't necessarily, I don't want to give it all the way to charity now, but what if, I'm leaving it for my surviving spouse and my surviving spouse doesn't need the full 5%? Can I be extra charitable? Meaning, can I just say, okay, well, up to 75% of the 5%, meaning 3.75, do I have to leave it to my spouse? Can I give someone or give my spouse the ability to say, oh, I don't want that extra 75%. Just go ahead and give it to charity. That seems nice. If anything, it's more money going to charity. It seems like you would want to encourage this, but unfortunately, it doesn't work with our current tax rules. What the IRS came back and said is, okay, well, what about an estate tax charitable deduction? The fact that some of this money might go to charity, we certainly know the remainder, but what about the unit trust interest? And they said, nope, no deduction for the unit trust because there's no guarantee 75% or any percent will go to charity. It's totally discretionary. So no estate tax charitable deduction. So then they threw up their hands. They said, well, what about a marital deduction? It's going to go to my spouse if it doesn't go to charity. And the IRS said, wait a minute, no marital deduction either. Why? Because we're only guaranteeing 25% to your spouse. The other 75% might go somewhere else. Now, the taxpayer is pretty frustrated because they said, look, clearly 100% of this is either going to charity or the spouse. Can't you just combine the two and we know it's going to one of the two and I shouldn't have to pay estate taxes on it? But the IRS said, no, that's not what it says. That's not how our rules work. Section 2055, Section 2066, 2055, they're not a balancing act. Kind of like that warning case. You can't put it all together and just say, hey, here's the end result. And so in this case, the IRS actually changed its position. Earlier rulings, private letter rulings, they thought this would be fine, but after further reflection, they said you can't do it this way. Now, there are still sometimes, too much for today, but there are creative solutions sometimes. I mean, you can always just give it all to the spouse, and then the spouse could make a deduction, but then the spouse would be subject to tax on whatever is being distributed. The other way is what's called setting up an LLC underneath the charitable deduction. And the idea with the LLC is underneath the charitable trust. And the LLC is almost like a spigot with faucets that control how much income comes out of the LLC into the trust that goes out to the beneficiary. Another thing we have to worry about too, and once again, is we've got to be very careful how you draft these. What was going on in the trust, this was someone who died, estate of block, and they wanted a charitable remainder trust created at death, and unfortunately kind of drafted it wrong. They said, I want the greater of 50,000 or the trust net income to go to the decedent sister or sister spouse. And there was even what's called a savings clause. In this trust document, they said, hey, I want to make sure that this is a charitable remainder annuity trust. The problem is you can't have an annuity trust that gives you the greater of 50,000 or income. It's got to be one or the other in general. If it's annuity trust, it's a set dollar figure. So in this case, what did they do? Well, they amended the trust effective on death. They sort of went to court eventually and they said, oh, let's just change it to 50,000, and they got rid of this net income requirement. That should work, right? It seems perfectly reasonable. The judge, the people, they're all on the same page. Unfortunately, the court came back and they said, wait a minute, this at the time you drafted it was incorrect. It doesn't qualify as a charitable remainder trust. It's not a quote, sum certain. You didn't say 50,000, you said 50,000 or net income. And then the taxpayers threw up their hands. They said, wait a minute, well, what about we did a qualified reformation. Don't we get some forgiveness? There is this provision that allows you to get it fixed in court. And they said, well, if you read that ability to reform or fix something that you've done wrong, you've got to do it within 90 days after the estate tax return was due, which they didn't do. And it's got to be instituted by the court, meaning you actually have to have the court approval blessing of this. And since they didn't have the right language and they didn't fix it the correct way in the right time period, no charitable deduction. So you had to pay estate taxes on this, even though it was eventually going to charity. All right, trust and estates, we just have to be careful. If you have a non-grantor trust or an estate giving to charity, that's great. The rules are different than for individuals. It's got to be paid from gross income. It's got to be paid pursuant to the original governing document. So you can't really amend this trust in court and then eventually allow gifts to charity. Be very, very careful there. The IRS doesn't like it. It's got to be part of the original document pursuant to gross income. Once it's in the non-grantor trust or estate, I mean, first the rules look good. None of these percentage limitations like we deal with individuals. Unlimited amount. You can give all your gross income to charity if you want. Estates and pre-69 trusts, they can even get a permanent set-aside deduction. For other trusts, non-grantor trusts, you can take the deduction this year, you can give away the money next year. So there's very generous rules, but it's under 642C. It's not the same rule for individuals. This is what happens when people leave my presentations too early. You got to be really careful. I already told you, yes, give away appreciated property, long-term held securities. That works for individuals, not for trusts and estates. And this actually was a case that came out a few years ago. This is Marty Green. This is the Hobby Lobby family. And what happened was he thought, hey, people are always telling me as an individual, give appreciated property. So this is the son. He's the trustee of this trust. So he gives away all this appreciated property and tries to take a full fair market value deduction for the non-grantor trust. Now, it did go to the district court, state of Oklahoma, and the district court, they said, hey, we give away appreciated property all the time. That's what it says individuals can do. Why can't trusts do it too? And so he actually won in district court. Now, the difference between district court and the Court of Appeals, so it was appealed to the 10th Circuit Court of Appeals, is that the Court of Appeals actually reads the Internal Revenue Code. They actually read the regulations, they look at the law, and they say exactly what I'm telling you now, and that is trusts do not take deductions like individuals. It's got to follow 642C, and nowhere in 642C does it say you get a deduction for appreciated property. So let's kind of go through what's going on here. I'll just give you an example. It's not just appreciated property. We have to be careful with trust. Remember I said 100% of the income, gross income, can be deducted if it goes to a charity, but that's not exactly how the rules work for charities. So let's just assume you have a mandatory income beneficiary, you've got a discretionary beneficiary, and you give money to charity. So I'm going to sum up a 15-week course in income taxation of trust for you in one slide. So what happens when money goes into a trust, let's say $100,000 of income, where does that taxable income go? Even if you make a gift to charity, the taxable income goes to people who are required to get income first. Even though you made a gift to charity, the taxable stuff goes to the first-tier beneficiaries first. Only if any taxable stuff is left do you get a charitable deduction, and then whatever is left goes to the discretionary beneficiaries. The trust itself doesn't care. It's not going to pay tax on what it gives to the beneficiary. It's not going to pay tax on what it gives to a charity. So it doesn't really care. But do you know who cares? The beneficiaries care. Why did you give money to charity? You got no tax benefit. So in this case, what could they do differently? Well, if you have a friendly family, maybe if you're in this situation, it was drafted this way, maybe instead of giving the money to charity from the trust and getting no deduction, maybe you could possibly give the extra money to Amy. It's a tax-free distribution. She's already paying tax on what she got. And then Amy can turn around and give that money to charity. Hopefully she's a friendly party. You can't force her to do it. But if Amy gives that extra $100,000, she can get her own personal income tax deduction, once again, as an individual subject to whatever AGI rules, 5-year carry forward. All right, I'll quickly go through. Everyone should just be familiar. Private foundations versus donor advised funds. There's pros and cons of each, but unless you're really trying to do something creative, donor advised funds, even especially now, I'm talking with clients with $10+ million, the donor advised fund is just such a simple, low-cost solution, so much administratively easier. You don't have to deal with all the filings. You can do anonymous gifts. You don't have to worry about, it does say private foundation, but they're not private. Everyone's going to know your business. They're going to know your addresses, who works there, what you're giving to. Donor advised fund works for many more. That's why part of the reason they're so popular. There are proposed regulations that just came out. We've been waiting for them for years. There were a lot of comments. I would not expect these to be finalized in their current form. One of the most outrageous things that was proposed is they said, right now there's a lot of donor advised funds that are managed by professional wealth management firms like mine. We have lots of clients. They work with community foundations. They work with some of the big custodians. You're talking Schwab, Fidelity, you name it. And these are people that want their good wealth managers helping to manage those funds. What these proposed regs say is, wait a minute, if you want to hire an investment manager and you pay them, then that's disqualified. We're going to cause that to be taxable. That's a taxable. Oh my gosh, we're going to charge an excise tax. This is now nowhere in the code does it say you're supposed to do this. These are proposed regulations. Now there were over 150 great comments against these proposed regulations, and the Treasury and IRS are well aware of the problems with what they proposed. And the reality is, I totally get it. If if somebody wants to pay their son or grandson $500,000 a year to manage their donor advised fund, that does sound abusive. That's the type of stuff that people do funny business with private foundations. But if a donor advised fund wants to hire a third-party professional wealth manager, that shouldn't be disqualified. That shouldn't be a deemed distribution. And so it's unlikely that this will be finalized in the current form. We even have this new Supreme Court case that if the Treasury tried to finalize it in this way, it would be likely overreaching. The Loper-Bright case said no longer does the Supreme Court have to defer to federal agencies like Treasury. That if the judge were to see them try to make it illegal or a deemed distribution for using a third-party, neutral, independent wealth manager, very likely they would find that to be overreaching. That's not where the statute goes. There have been other reform proposals. We see these from time to time, almost every year or two. The reform proposals usually are about, oh, this is awful. Donor advised funds are just allowing these rich Scrooge-like characters to never give money to charity and get a tax benefit. And they blow this out of proportion. And the reality is, private foundations have to give at least 5% away or spend 5% every year. Donor advised funds do not have a required distribution each year. But if you go around to all of the community foundations or the major community foundations, maybe not all, but at least most that I'm aware of, most of the major community foundations, most of the major financial institutions, they have double-digit distribution rates from donor advised funds every single year. So forget about a 5% requirement. They're doing more than 10 every single year. The problem is, it's in the aggregate. There certainly are some donor advised funds that don't give any money away in certain years, but there's a lot of reasons for that. Maybe someone was having medical issues and they didn't get around to giving to charity. Maybe it's some executive, or a business owner, they just sold their business, they set up their donor advised fund, and they're not ready to put the time into really giving away proactively and thoughtfully. It doesn't mean that they ever get that money back. That's not their money. It's permanently given away. But once again, it's more of a political thing from time to time. It's almost like a solution looking for a problem. But for right now, there is no mandatory distribution requirement. But it doesn't mean donor advised funds are always perfect. Oftentimes, the problems that we've seen happen when somebody tries to go directly to the donor advised fund, especially very wealthy people, and maybe they're looking to save money, or maybe they don't have a good wealth manager. I don't know what the result is, but this is the problem when you try to do it sometimes on your own. And so here's the Fairburn case against Fidelity. These were some very successful business owners. They're selling, and they donated part of their business to Fidelity, and they said, look, this is a very thinly traded stock. If you sell this all at once, it's going to depress the price. So I just kind of, use round numbers so you understand. So the idea is, hey, if I'm going to put 100 million here, and if you sell it all at once, it's going to fall in value to 60 million. I'm going to lose a big portion of my deduction, and I'm going to have less money in my donor advised fund. Now, in all this correspondence back and forth with Fidelity, there was emails and materials about how we have this sophisticated algorithm trading, and we're totally aware of your issue. And yeah, absolutely, you don't have to worry. We are sophisticated. You don't have to worry. This is Fidelity. So what happened after the donor actually donated the shares? Fidelity turned around that day at the end of the year and just sold everything all at once. What did that mean? Average high and low prices. It meant their deduction was substantially lower, and they had less money in their donor advised funds. So what do you do, especially in California? You'll see these cases tend to come out of California. They sued, and they lost. What happens is, once you donate to a donor advised fund, it's not your money anymore. All you get to do is make suggestions of what charities you want to choose, but it's up to the donor advised fund to manage it. And maybe that was the right call for Fidelity. This could be a risky stock. They'd rather be in a diversified portfolio. If someone has a problem with the donor advised fund, it's up to the Attorney General of the state. California's Attorney General didn't have a problem with them doing this, but you as an individual, your gift is done. You already made your gift to the charity. You can't now turn around and sue the charity. It's not your money anymore. I won't just pick on Fidelity. I'll pick on Schwab. There was another case, Pinkert v. Schwab. Once again, it was a person that went directly to Schwab. They're not necessarily working through a wealth manager and setting up their own investment and going to different investment choices. So directly at Schwab, and the guy said, hey, wait a minute. This is supposed to be a charity. Schwab's just using their own charitable retail funds. They're not even giving me a discount. They're hiring Schwab people. They're advertising Schwab. Wait a minute, this can't be right. I want to sue them. They're failing their job as a standalone charity. What did the court say? Very similar to the last case, Fairburn against Fidelity. And they said, hey, you gave the money away to Schwab, charitable fund. It's in a charitable fund. It's not your money anymore. Once again, if the Attorney General has a problem with it, the Attorney General can go over and see if they're up to no good or if they're abusing anything, but you don't have legal control over these donated assets. They're out of your hands. The only thing you retain is the ability to make suggestions of what ultimate charity it goes to. Now, charitable LLCs, they're around. We definitely, there are some people, this is a good fit, but this is, if you remember from Facebook, Mark Zuckerberg set one of these up. Now, at first, it seems like it's the most brilliant solution ever. You've got an LLC, there's no mandatory distributions, none of this attorney general oversight, no public filings. You can do charity, you can do private, you can do whatever you want. So at first, an LLC sounds like, why isn't everyone doing this? Why would you waste time with a donor advised fund or a private foundation or a public charity? And the reality is because an LLC is really just a tax nothing. It's not exempt from tax. There's no tax deduction when you set it up. So we'll get to some of the abuses, but it's not really a charitable entity. Now, if that LLC ever actually makes a charitable distribution, you will get the deduction. But until that happens, it really is just great for a client that wants to do a bunch of charitable things, doesn't want to deal with the donor advised fund or private foundation limitations or reporting, and they don't really need the deduction today. They'll get the deduction when the LLC actually gives that money to charity. Patagonia is another one that made the news. Not a lot of people, I don't know how many billionaires you work with are doing this, but the idea was two things. One, put voting control into what's called a purpose trust. You can do this in states like Delaware. And I just want to keep this company going as long as humanly possible. And so they just set up a special trust to keep this business going, as opposed to having, let's say, specific beneficiaries. The beneficiary is a purpose, keeping this business going. Now, what's really controversial is 98% of the company was given to what's called a 501c4 social welfare organization, as opposed to our traditional charities, which are 501c3s. So close to $3 billion without discounting, now no gift, estate, or GST tax. So they save 40%. And this is very, very clear. That would have been over close to a $1.2 billion tax if it was subject to taxes. Now, once you get it in this organization, no income taxes, it's growing tax-free. So you've put it in a tax-exempt entity. You've never paid tax, no income tax, no gift, estate, or GST. Now, it's not a 501c3, so there's no charitable tax deduction, because you'd say, well, why don't you just give this to a 501c3 and get a charitable deduction? Well, maybe you don't need a charitable deduction. You know, even over 5 years, maybe you're not going to write off close to $3 billion of income taxes, but it's not just about the charitable deduction. A 501c4, what it is able to do that a 501c3 is not able to do, and that is use money for political purposes. Now, in this case, for some of you listening, you might love what Patagonia or this 501c4 is doing, save the world, heal the environment, you name it. You might be in favor and like this cause. The problem is a 501c4, you can get another billionaire with twice as many billions, if not 3 times as many billions, put their money into a 501c4 for something that you're against. Maybe they want to, take down the national parks in this country and fill it and turn them into toxic waste dumps. That could be a social welfare organization. So just be prepared that what you're allowing is these huge political machines, but they can go on either side of the political spectrum. And that's sort of the danger and the fear over these types of major nonprofits. Yes, you don't get a charitable deduction, but you're allowing wealthy people to fund these with no gift, estate, or GST taxes. SRI, just make sure you're aware of it, not just for these charitable entities you set up, donor advised fund, private foundations, but even for people that are giving to charity in general. They might want their regular investments to be used for good, or at least not used for bad. Now, private foundations do have additional flexibility. You can do program-related investments, things like, impact investing, or you can do loans. But I'll tell you what, SRI, there's funds that are out there, a lot of controversy over what qualifies, what doesn't qualify. For most wealthy individuals and wealthy families, this has to be customized. I'll tell you for our experience, and that is either whether it's negative screenings, we don't want to invest in this, or positive screenings, we want companies that do that. Whatever their hopes, desires, dreams, values are, it should be customized because everyone's different. Everyone defines this in different ways. So the idea of just throwing it into a fund and thinking everyone agrees with its overall values and goals, oftentimes what you can do, at least with good wealth managers, is customize an investment portfolio to reach some of these goals, depending on what the family or that charitable organization wants to do. All right, just a few minutes on scams, just so you know they're out here. I'd already mentioned how charitable remainder trusts are great. They're in the code, but like any good thing, there are bad people out there abusing it. And so this was this whole idea. People were saying, hey, do a charitable remainder trust. And what you want to do is buy an annuity from me, and all of the taxes will disappear. And they throw out some like rules in the code, and they think they're smart. They're throwing out a lot of code sections. The problem is it doesn't work. Charitable remainder trusts are incredible strategies. We'll talk about it a little later, but for the right client, they can be great. They're blessed. They're in the code, but if you're going to abuse them, it doesn't work. Charitable remainder trusts don't eliminate income tax. They do defer income tax. And so this is really just a ruse to get people to buy a strategy and sell them an annuity. And what happened is it absolutely lost in court. The promoters were enjoined from selling this anymore, at least the ones they caught. Remember, they get the customer list, and then they can go after all the taxpayers that used this inappropriate scheme. And they did. They went after and Gerhard. And so the problem is you can't do this. What we have now are proposed regulations. By the way, Treasury can't believe that they have to come out with the proposed regulations to tell people you're not allowed to do it. It's clear under the law. It's clear in the code. It's clear under these cases. But that's just how our government works. You have to go through a notice period. So Treasury is aware of this, and they're going to make it absolutely clear that if you do this, you're going to be subject to significant, not only does it not work, but you're going to be hit with big penalties if you try this scheme. Once again, a way to defer people from doing the wrong things with bad people. Same idea with art donations. Look, the IRS has an entire group that just all they do in life is, art. That's their world. They know what art is worth. And here are these promoters, and they come to people and they say, look, hey, why don't you buy this piece of art from me for $5,000? I'll take care of everything, the appraisal, the shipping. And then what you'll do is you'll get a deduction for $100,000. Buy it for $5,000, we're going to get to a $100,000 deduction. We're getting you the special discounted painting, and it's worth so much more. And people buy into this, and the IRS has warned people. They've already produced more than $5 million in additional tax. Once they find you, and once again, this is penalties, this is interest. You've got to be careful. Just because people are trying to sell you something doesn't mean it works. And it's just really unfortunate trying to tell a good tax advisor from a bad tax advisor or an unscrupulous tax advisor. And I don't even think these people rise to the level of tax advisors. These are tax shelter promoters, but be very, very careful, or at the very least, get a second opinion from a good attorney, a good accountant, a good wealth manager, someone to tell you, should you really be doing this? Speaking of abuses, I talked about charitable LLCs. Once again, like any good thing, you can set up a charitable LLC. Of course, look at Chan Zuckerberg, but you can't abuse it. And there was this promoter, Michael Meyer, by the way, who was sentenced to prison 8 years. So the promoters actually are ending up, they're getting prison time for what they're doing and promoting some of these bad structures. But remember, people are paying them, look, in this case, $84,000 a pop. I mean, that's a lot of money for something that's technically illegal, but he's setting it all up. And the whole idea here, and this is an attorney, these are attorneys and accountants. And what they're saying is, oh, set up an LLC, but you don't even have to put any money in. Just promise to pay the LLC, donate the LLC to charity, and get a big deduction. And the court said, look, this is all a scam. It's a sham, step transaction. The only thing they said in this case is that maybe we'll entertain, since it was a CPA, an attorney that tried to sell this to you, were you able to rely on their advice to at least bring your penalties down? Was there reasonable cause? Let me walk you through sort of, here's your basic charitable LLC. Just set it up, put your money in. That's the way it works. There's no deduction. there's no tax-free appreciation. You kind of put your money in, but when you're ready with the charitable LLC, if you give the money to a charity at that point, that deduction will flow through. This is the vast majority of above board charitable LLCs. How are people abusing it? They're saying, oh, well, don't put 20 million in. Why don't you just promise to pay 20 million and then donate 99% to the charity? And how much is the deduction worth? Oh, well, once again, we will take discounts because you're not giving 100% away, you're giving 99%. So let's say it's worth, with a 20% discount, around $16 million of a deduction. You definitely gave something away. You're allowed to donate LLCs to charity. That happens. But what's this whole step transaction? Well, what's the public charity actually getting out of this? And the answer is nothing. The donor's paying a minimal interest to the charitable LLC. That interest, even though it's tax for tax purposes allocated to the public charity, it doesn't mean the charitable LLC is actually making any distributions. Remember, the donor controls it. And then what happens is, in a couple years, the donor turns around, goes to this public charity. They've already taken a $16 million deduction for something they haven't even put any real money into. And they go to the charity and they say, oh, you know, why don't we make this whole thing go away? Why don't I just give you a check for $500,000 and call it a day? And the public charity might say, well, I'm not getting anything out of this. Fine. We'll get rid of our 99% interest. Just give me $500,000. And this donor, in theory, for only paying maybe $500,000 or $1 million or whatever it is, got a $16 million deduction. Unfortunately, this doesn't work. The court has been very clear. The Department of Justice is going after this transaction. Now, have people gotten away with it? Sure. But they've gotten away with it so far. They just haven't been audited yet. We know this isn't appropriate. There's still people aggressively marketing this type of transaction. People just need to be very careful. And we're talking about potential penalties. Let me look into the question. There's a question on this. It looks like there's a few here. CRUT. Oh, this is the single premium immediate annuity. Was it purchased by the CRAT or outside of the CRAT? So the question was, this has to do, I'll just kind of summarize it real quickly for everyone. Getting back into one of these things that there's proposed regulations. And the idea is, once you have a charitable remainder trust, you can buy an annuity. It's in the trust. But you can buy stocks, you can buy bonds, but it doesn't mean the taxes disappear. An annuity itself is probably not the most tax efficient investment. Why? Because when that annuity starts paying out, in order to make these charitable remainder trust payments, it's taxed at ordinary income levels. So most often what we see, we got to remember, there's a type of taxation with CRUTs. It's called worst in, first out. So the CRUT can invest in all of these things, but the highest taxed income, like ordinary income, comes out first. So you sell your thing, you can sell it, and we'll get to this in a second with charitable remainder trust, but that charitable remainder trust, whatever it's investing in, the higher taxed items go out to the beneficiary first. So generally what we want to do is avoid those higher tax, especially whether it's an immediate annuity, or we sometimes see people thinking, oh, I've got a charitable remainder trust. I can just willy-nilly, it's a tax exempt entity. I don't have to wait long term. I can just churn this portfolio every couple of weeks or months. The problem is then you're generating short-term capital gains, taxed as ordinary income. So be very careful with charitable remainder trust. Make sure you have a professional wealth manager that not only knows how to manage money, but knows how to manage money for charitable remainder trust. So we do have some time left. So now everyone's hopefully thinking, wait, these are all great ideas. How do I get donors to do it? I don't know about all of you, but have you ever had a donor or a client, you've given them great advice and they just haven't taken it yet? And for some of us, that might be most of our clients. I don't know, most of the donors, but you want to help them. You've got this great advice. How do you get them to implement the advice? So let's walk through what I call philanthropic planning paralysis, getting your clients or donors to act. So first, is this an even issue? And the reality is yes. This is very common, whether it's estate planning, trust planning, charitable planning. People are hesitate. It's very, very common human psychology. Business owners, there's a lot of statistics, 73 to 83% no succession plan, 50% expecting to retire in 5 years, no successor. Most of them, 64%, no capital gains planning, no estate tax planning. More than half don't even have buy-sell agreements. And the one that kills me, and this is general, this isn't just business owners, but around the country, a third don't even have your basic estate plan. So most of our clients are paralyzed. They're not doing, most people in the country, how do we get them to take action? So before we get into how, why are they not taking action? I'll just give you some of the reasons we see. I mean, let's just take the S&P 500. Here was where it was back in 2021. Here's where we are in 2024, June to June. Now you'd say, why are people afraid to take action? This looks fantastic. I mean, we're way up. In fact, if you look at least yesterday's close, I don't know where we are this second, but we're somewhere around 5,800. So it's even better this year. Why would this cause people to be afraid to donate to charity or implement a trust or an estate plan? And the reason why is because the stock market does not perform in a straight line. That certainly is where it started and ended, but it's a roller coaster ride. All of these ups and downs. We didn't get back to the height of 2021. We didn't get back to that height until 2024. We're way up now, but how are you going to handle a 25% drop? Let alone, let's think if, where we are today, if the stock market drops 1,500 points tomorrow, are our clients going to turn around and say, oh, what a great time to donate to charity. This is fantastic. I just lost 25% of my net worth. Can I give to charity? So this is what scares people. And by the way, if you take all of this noise away and just look at this chart, this looks like an EKG chart of someone having a heart attack. And that's what our clients and donors are feeling. There's a lot of news. It takes a lot of news to fill up a 24-hour-a-day news channel. And this is what our clients, those ups and downs, and it's preventing a lot of humans. This is the fight or flight syndrome. And the idea is they're paralyzed. They don't take action. And it's not just about the stock market. It's everything else that's going on in the world. Interest rates, inflation, it could be liquidity needs. Oh, I've got to sell this and pay taxes. Do I have the ability to pay cash flow, ability to pay my expenses with cash flow? What about taxes? Where are we today? Where could we end up? What's going to happen with the Sunset Tax Cuts and Jobs Act? What about the global economy, Europe, China, you name it? So there's a lot of reasons people don't take action. And what we find is, how do advisors approach this? Knowing that our clients and donors have all of this fear and anxiety, most advisors just completely ignore it and start throwing out acronyms. That's what we do as advisors. We've all been guilty of it at some point. And don't get me wrong, as advisors, we know and love these acronyms, GRATs and CRUTs and CRATs and all these great strategies, but it doesn't work for clients. It doesn't work for donors. We deal with these on a day-to-day. I even had one client, there's a young couple in their 40s, very, very successful. They were in the meeting with the lawyer and they started playing like a word jumble out of all these acronyms to see like, oh, what words can we create? And they were laughing and having fun. This was all going over their head. It wasn't allowing them the psychological experience to actually take action. And so why is this? So I did sort of a rough study. I go to hundreds of meetings with attorneys and accountants around the country. And what I did is I started to chart the planning techniques and what the advisor thought of it versus what the client thought of it. So just take from simplest to most complex. And when I asked the advisor how the meeting went, here was the response. I kind of paraphrased, but I'll give you sort of the two best responses for the advisor. As the plan got more and more complicated, what did you think of the meeting? What did you think of your advice? And what the advisor said, oh, well, my advice got more and more brilliant, but it wasn't just egotistical. The advantages and tax savings went up. And the advisor is completely correct. It definitely is more sophisticated advice, more advantages, tax savings. But what did the client tell me? Same exact, from easiest to most complex type of plan, especially involving whether it's trusts or strategies, philanthropic activity. And what the client said is, as it got more and more complicated, how much hassle and aggravation is this going to be? Because for a lot of our clients, whether it takes an extra hour, a day, a week, a month, that's not something they necessarily want to do. But it wasn't just about hassle and aggravation. How much is this going to cost me? This is just human nature. And some of the wealthiest clients are the most cost-conscious clients. And they are right. The more you do, very likely, the more expensive it's going to be to implement. And the question is it worth it? So how do we get them to act? I'm going to walk you through 3 steps. These steps will give you the exponentially highest likelihood to help your client take action. Once again, whether it's trust planning, estate planning, philanthropic planning. So let's just start with, where do you start with the client? Investigate. A lot of people throw out solutions. You should do this, do that. But until you know what you're solving for, the client's not going to really want to implement it. And so as advisors, we always focus on the left-hand side of the equation, and these are all important. your legal documents, asset protection, privacy, reducing taxes, your investment returns. That absolutely is important, but oftentimes we forget about the softer side. What's the impact on the family? What about generation 2, the grandchildren? What about giving together as a family? Ultimately, we need to find out what are the important things to the client. We've got to get the client to tell us with 2 goals in mind. Certainly at the bottom, we certainly want financial success and tax savings, but for a lot of our clients and donors, family harmony. What kind of solution is going to keep the family together at the end of the day? Let's say they can all sit together at Thanksgiving at the end of the year. What are those solutions that we can do that will address what's important to the client or important to the donor? So how do you find out what's important? You just ask them, but you got to ask them with specific types of questions. These are what you might call explicit needs questions. Now, if you go back, there's been a lot of research on just the art of asking questions. And what people have found is that yes and no questions, which you might call closed-ended questions, yes and no questions don't engage the answering person's mind, and they're less likely to buy whatever product you're selling. Whereas if you ask them an open-ended question where they can't answer it with a yes or a no, they're more likely to take action or buy whatever it is you're selling. Now, the older research dealt with selling products, and the idea was to get them to engage their brain. But in this case, when we talk about planning, we're not selling products, we're offering advice. But how do you get them to want to implement your advice? How do you get them to want to look to you for a solution? They have to want a solution. So you have to create what are called explicit needs questions. I'll share some with you. And you ask these questions so they can turn around and tell you, oh no, I have a problem. They're going to own their own problem and they will look at you for a solution. So what are those questions? Let's just start with, how has uncertainty in the current environment impacted your charitable giving? I don't know if that's an issue. I don't know if I need to throw out a charitable remainder trust, but if it's someone who wants to give, are they concerned they might not have enough money? Maybe if that is a concern, we need to come up with a solution that will take care of them for the rest of their life and provide to charity. But if this isn't an issue, then we have to keep moving on. Maybe that's not their problem at all. What about asking them, and rather saying, hey, do you have a plan? Why don't you even ask, in what ways have you documented your values and charitable goals? That's not a yes or no question. This really puts the onus back on them to say, oh gosh, I wanted a big gift to go to charity. Is that going to happen? Was I supposed to have written it down? How do I write it down? Now they own the problem. They'll look for you to you for a solution. How are you providing to charity while accomplishing wealth transfer goals? They're not necessarily mutually exclusive. You might be able to do both. We can do wealth transfer and charitable planning at the same time. But when you ask it as a question, they start thinking, I never thought I could do both. What have you done to prepare your children to receive your wealth? A lot of clients have done a lot about estate and trust planning to get the dollars in a tax efficient manner, but are the kids and grandkids ready for that? Philanthropy could be a good way to get them ready. And last but not least, just another example, what assets have you considered for charitable giving? I don't want to just tell them, hey, you should donate appreciated stock. Maybe they already are. Maybe they've never thought of it. But if I just give them the solution, they're not really thinking of it. But if you ask them, have they done? What have they considered? Now they're going to feel like, uh-oh, am I missing out on something? Is there something? They're going to realize they have a problem and they're going to tell you, I explicitly need and want a solution from you for this. Step 2, we've asked the right questions. How do you communicate the solutions? We've asked the questions, they own the problem. How do we communicate? 2 of the best ways to communicate: stories. The research has shown that stories work. They're persuasive, they're compelling, they're memorable. This is how, as humans, before we even had written word, we used to use stories to communicate generation after generation. And the best stories are going to elicit an emotional response, and it's that emotional response that leads to action. What's really interesting, there was a 2010 study out of Princeton. They actually hooked the storytellers and the listeners to MRI machines and measured their brain activity. As the storyteller told the story, the listeners, the same parts of the brain would light up in the listeners as the storyteller told the story. Different parts of the story, different parts of the brain would light up, and then it began to be mirrored in the listeners. In fact, as the storyteller went on with the story, the listeners began to anticipate where the storyteller was going, and the part of their brain would light up before the storyteller's brain even got to that part. And so it just shows we connect as humans on a biological level with stories. One of the best ways to communicate, rather than lectures and numbers and all this, but in addition to stories, visuals. Visuals work. This gets back into, you may have heard of like left brain people. These are mathematical, analytical, a lot of attorneys and CPAs. And then there, as my wife likes to remind me, there's everybody else in the world. And those are more right brain people. These aren't, necessarily, they might like visual artistic. So we're talking about flow charts. We're talking about graphs. We're talking about something they can see. And the idea is nobody in this, the actual research comes from the original research. This was a Nobel Prize winner, Roger Sperry, for a research he had done on split brain patients where they actually did have half a brain. Now, we're not dealing with people that have half a brain. Unless any of you have teenagers, sometimes it feels like they have half a brain. But when we're talking with clients and donors, nobody's completely right brain or left brain. Most people, they're going to use both, but they definitely have a preference in the way they want to learn. So by using visuals and by using stories, you're making it as easy as possible for them to take your advice. That's what you want to think about when you're communicating. And this gets back into behavioral economics. Richard Thaler at Chicago, University of Chicago, if you want to encourage someone to do something, make it easy as possible. Another Nobel Prize winner recently passed away, Danny Kahneman, did a lot of work with Amos Tversky, who had already passed away. People will eventually gravitate to the least demanding course. So when we're giving our solutions, let's make it as easy as possible. Let's use stories. Let's use pictures. And you can use pictures and one-page flowcharts for anything. For instance, we had one, this was a huge box of documents. Husband wanted to change his documents and leave a bunch to his private foundation and outright gifts to charity. And the problem was his wife was concerned. She's like, I might not have enough. I don't know if I want to agree to this change. And so what we did was flowchart. By putting the flowchart, they could understand it instead of going through boxes of materials and all these summaries. And so we started off, we showed the husband, when you die, nothing will go to the IRS. At this point, husband said, great, perfect plan, where do I sign? But his wife wasn't ready. Now, the wife had her separate property. She was in her 70s, 7.5 million. We ran the numbers. It was very likely she would never even touch the entire 7.5 million. But she didn't feel comfortable psychologically, emotionally. So what did we show her? We said, okay, all these fancy schmancy other trusts, and they made other gifts. So your GST, residuary family, all of those other green trusts would be there for the wife for the rest of her life if she ever needed it. And now she realized it wasn't just her 7.5 million. There was going to be plenty of additional money if she needed it available for her. And because of that, they were willing to do these extra gifts. Private foundation and specific charitable gift. Actually, husband came back into the picture at this point. He said, what about gifts to my kids and grandkids when I die? I want them to get something, not waiting around for their mom to die. And in this case, we were able to show them, yes, they will get their cash gifts too. Now you might say, okay, well, that was really easy, Justin. That's your basic estate plan. But what about the more complicated strategies? Here's my top 10 list. It's in the materials for you. This is probably the top 10 strategies we've been seeing over the last couple years. But how do you communicate some of these strategies? So let's just take the charitable remainder trust. I like this one. Great income tax planning strategy with appreciated property. Great way to diversify if you have a concentrated position or if you're selling real estate and let's say you don't want to do a like-kind exchange. So here's a nice bullet point summary. I'll tell you, best bullet point summary I've ever seen. I should know I wrote it. So, but I'll be the first to tell you. Nobody's going to remember this, unless they're a lawyer studying. Most clients, the only thing they're going to remember on this page is the word CRUT. They might remember charitable remainder trust. This isn't going to convince anyone to do anything. Same thing with a lot of times I see the Excel spreadsheets and calculations and all this stuff. I love this. A lot of it, maybe if you have engineers as clients, they might like this, the numbers. And this is where I see especially old couples and they pull out magnifying glasses and their fingers go all over the page and they can't figure out. This works for me. This is not going to convince most clients to do anything, most donors. So how do you do it? How do you use pictures? I'll walk you through a quick example. Let's just say donor is going to give to a CRUT, a CRUT. They've got this appreciated asset. The first thing they get, depending on how much money they're going to take back, is a deduction. Day one, even though charity doesn't get the money till they're dead, they can leave it to their donor advised fund. They can change their mind over the final charity, but they get a deduction day one. Then that CRUT can sell the asset. The taxes don't disappear, but they are deferred. So if you got like an asset, let's say a concentrated position and big built-in gain, you don't pay any taxes on day one. You get to invest that entire 2 million. Now, as the money comes out, in this case, the way we ran the numbers, 6.6, the money comes out, those capital gains will come out. But instead of big capital gain in the highest tax bracket in year one, you're spreading it out over the rest of your life. So you're not in the highest tax bracket, and you're more or less getting your money back. In this case, this was someone in their late 30s, they're going to get way more than $2 million back out of this trust. Now, if they continue and invest it in this CRUT, it could be stocks, bonds, private equity, you name it. The idea, though, is at the end, let's just assume conservative net return after fees, 7%, 2.1 million left for charity. This is the benefit. You get a deduction day one. You get to defer your taxes. You get your money back and then some. And the fourth benefit, the cherry on top, money to charity. The only one that loses in this case is the IRS, and most people are okay with this result. And if you put it in this type of flow chart, they're more likely to do it. Final step, step 3, I'll blow through this in our final minutes and I will get you out on time. Let's say you've asked the right questions. Explicit needs, what do they really need? You've communicated, you have the best stories, you told them about how it impacted other clients like them, you had great flow charts and visuals. You got to get them to actually take action now. Now, you can't just say, oh, one day you're going to die and you have to do it. Death is not a motivating factor. When people think of death, they're not thinking, I got to do some tax planning or something like that. There are exceptions. I call it the 3 Ds. If their relative died and left behind a mess, if they're about to get divorced, if they're about to do a big transaction, that might be a time they think of doing some planning. Maybe if they're about to undergo surgery, that might be a good time to get them to do something. The other time I've seen this with parents, you don't know how many parents of young children, they sign their wills and trusts only because it's the first time they're ever leaving their kids alone on, let's say, an international flight. But you can't create these types of situations. This is just relatively lucky timing if you want them to do planning. So how do you motivate people to take action? Show them the reality. For older Americans, chances are they need to take care of this stuff now. It's not just a matter of having one of these chronic conditions. Most older Americans have 2 or more chronic conditions. Very likely at one day they're going to need help with what you might call activities of daily living. Elder abuse, and by the way, this isn't just people you hire. Oftentimes it's family members, one of the quickest growing crimes in this country. And these are just the reported cases. A lot goes underreported. That's why we want to put these plans into place. It's not just about, what happens when you get older. You could be in a car accident. The whole idea is what's going to happen with your money to you while you're still alive, let alone when you've passed away down the road. And then show them the pictures. Yeah, we've got this exemption amount. We know it's going to be subject to very likely be cut in half starting 2026. And this could be the case regardless of who's president. It's going to be very, very expensive to keep this exemption amount going over another 8 to 10 year period. So it's likely we could see this opportune time this year and next year disappear starting, or at least cut in half starting 2026. Interest rates could have a big impact on what it is we're giving to. We are starting to see a small drop. I think it's closer to 4.4 in November, coming down. But the idea is interest rates will impact what strategies you use, what your returns are. We also don't know what's going to happen with taxes. Right now, 40% estate tax rate. It could be historically for the 70-year period. Prior to 2001, almost the entire 70-year period, estate taxes were 55 to 77%. So at 40, we don't know. It could go back to something else down the road. The other thing is you got to show clients, it's not just about the benefit in general. Here's a client we worked with, the client we said we had to show them the cost of procrastination. Sure, you don't have to do this today, and we can show you, you'd save a lot of money if you put this into plan today. But what happens if you wait 10 years and your business or your investments keep growing? We showed them, if you wait 10 years to do this plan, you'll owe an additional $23 million in taxes. In this case, we broke it down for the client by month. We said, don't rush it. If you don't want to do anything today, totally your call. Put this on the shelf. Let's assume none of the laws change that much. It's going to cost you $195,000 in taxes every single month for the next 10 years to do this plan if you don't put it into place today. This is where we really want to make sure it's not just the benefits of doing it, but the cost of waiting. Ultimately, since we're talking about philanthropy, a great motivating factor is get the children involved, get the grandchildren involved. You can do this. You don't have to use a big private foundation. You don't even need a big donor advice fund, but a donor advice fund works great. And it's not the dollar figures that matter. Research shows this works just as well with $1,000 as it does with $100,000. It's the act of working together. Everyone can do this regardless of wealth. And the idea is you want independence. So you want your kids and grandchildren learning independence and giving to charity, getting that good psychological benefit, giving and thinking of others. But it's also a way that everyone can work together. That means a 12-year-old and an 18-year-old negotiating, learning how to work together as a family. I'll warn you. Uh-oh, I see a warning. Please move this. Oh, maybe that's a sign. It's trying to tell me to, I've still got a minute and a half. Don't forget about family philanthropy. It's all about working together. All of those great things you get from working together, 12-year-old, 18-year-old, these are all things you're going to need for the family wealth down the road. Last but not least, we can't do it alone. This is why we have these groups, the Community Foundation, Trust and Estate Council. Yeah, I'm here with a great wealth firm, trust firm, but it's all about working together. It doesn't mean the client has all of these advisors, but let's make at least sure the attorney, the accountant, the wealth manager are all working together. That will give you the highest likelihood the client will implement your advice. And so I'll just sum it up once again. How do we get clients and donors to take action? Number one, investigate. Are you asking them questions that are allowing them to tell you what they need, what their worries, letting them own their problem? Two, how are we communicating? Are we just giving words and numbers? Are we using stories? Are we using charts and graphs? And last but not least, we've got to motivate them. Not just here's the benefits of doing it, but here's why you have to do it right now. And let's get all of our advisors working together because we want the best for our clients and donors. Let's work together to help them make it happen. And with that, more than enough for today. Thank you for joining. And let me turn it back over for any final comments.
Thank you, Justin. Wow, what a great information that you provided. Thank you. Thank you for doing this from California. And please, if you have any questions, I know some of you put your questions in the chat here. Feel free to reach out to Justin, as he mentioned, and to our development staff here, including me, Tom Griffith, Jan Lane. This video playback you'll receive it via email, and also will be posted along with our digital booklet that we had provided on our website. You'll receive that. So thank you everyone again I hope you found this beneficial, and now we'll conclude this presentation.
Thanks, Justin. Thanks, everybody.
My pleasure. Thank you, everyone.